This episode concludes our review of the first half of 2026 for economies all over the world. The theme of resilience is still playing out as the tough context threatens prosperity. Still, a trend of stronger reform backbone and fiscal discipline has helped most economies withstand the shocks. H1 was less about tariffs as the first half saw economies contending with high inflation amid weakened confidence as an energy price shock ravaged business activity and a common trend of high prices weighed on growth. The World Bank said global growth will slow to 2.5% in 2026, citing higher energy prices, commodity market disruptions, and the elevated uncertainty. Today, central banks are also trying to understand if indeed the surge in energy price has a moderately transitional or lingering, more scarring effect on inflation and what to do about it. In Europe, according to latest surveys, a near unprecedented cooling of cost pressures reduces the chances of further rate hikes in the near future as rate setters await greater clarity on how rapidly price pressures will fade. The first half 2026 had to deal with the fallout from the US-Iran energy shock on demand. The second half is starting with crude oil already flirting with below pre-war levels, but it is still a fragile ceasefire. The second half will also test the prevailing hypothesis of artificial intelligence as a global growth driver as more widespread application raises new issues on job loss, user acceptance, and cybersecurity. Hello and welcome to Global Business Insight, where we bring perspectives to help you navigate today's more complex terrain. This episode concludes a review of the first half of the year, and we also look at the final Purchasing Managers Index PMI data for H1 that just came out this week. In the US, the flash June PMI rose to 52.2 from 51.5. A 5-month high. Better Middle East news lifted confidence, though growth stayed below earlier year levels. Services grew modestly as high prices and weak consumer sentiment weighed on demand, while manufacturing was supported by inventory building amid wider supply delays. Job cuts reached their highest pace since 2009, excluding the pandemic, reflecting softer demand expectations and higher raw material costs. Sustained peace in Iran could lower energy prices, ease input costs, and support stronger U.S. activity. But you cannot rule out another black swan event, as we have seen in the first half of the year, that could potentially upend projections for the second half. Still, after 3 months of strong hiring, the U.S. economy added only 57,000 jobs in June, well below expectations. The weakness was most evident in leisure and hospitality, and it also makes a Federal Reserve rate hike this year less likely. The latest China composite PMI eased to 53.6 in June from a 3-month high of 54.0 in May. The latest reading remained among the strongest in the past 3 years, reflecting sustained expansion across both the manufacturing and services sector. Input cost inflation slowed to a 5-month low, suggesting easing cost pressures for businesses. The chart shows China in the first half attempting a revival, albeit still looking fragile, though an expansion trend has been sustained for over 12 months. In the UK, where the attention is shifting to the politics and prospective Prime Minister Andy Burnham is promising fiscal discipline and better times. According to a flash report, the S&P Global UK Composite PMI eased to 49.4 in June of 2026 from 49.7 in May, a second month of contraction following 11 months of expansion in the private sector. The services PMI data just out confirmed a clear loss of momentum for the UK economy in Q2 after a positive start to the year. UK services in June, PMI dropped to 48.8 from 49.3 in May. The latest survey indicated a decline in service sector activity for the second month running, and although only modest, the rate of decline was the steepest since January 2023. In Europe, S&P Global Eurozone Composite PMI Output Index just outposted outside of contraction territory for the first time since March. At 50.0, the headline index was up from 48.5 in May, signaling a stabilization in output following 2 months of decline. The overall stabilization in output and slight improvement in PMI was due to growth in manufacturing being offset by a further, albeit slower, decline in services. The good news is that the wider economy has stabilized after 2 months of falling output, as we saw a drag on growth since the outbreak of the war in the Middle East led to subdued consumer demand, due of course to the energy price spike. In the Eurozone, input cost inflation in the services sector fell in June to the greatest extent since data was first available in 1998, barring only that seen in the COVID-19 lockdowns of early 2020. This has helped support a revival of growth of services activity in some key sectors hardest hit by the war, notably leisure and tourism. The S&P South Africa PMI for April 2026 was 51.6, up from 50.8 in March, the highest reading since August 2022, but only to drop in later months, but still remaining in expansion. In the latest June print, the private sector returned to marginal growth as the reading signaled a third expansion in the past 4 months, helped by a sharp easing of inflationary pressures. South Africa PMI recovered in June, rising to 50.5 from 49.6 in May, to indicate an expansion across the private sector for the third time in 4 months. There is a silver lining from the June data in the marked cooling of inflationary pressures as input prices retreated after reaching the highest levels for nearly 4 years in May. In Nigeria, since August 2025, when the Purchasing Managers Index reached 54.2, we have seen economic activity easing slightly but remaining in expansion, except in January 2026. June 2026 PMI fell to 53.4 from 54.1 in May, while stronger demand continued to support output and new orders. Input costs and output prices rose sharply again, though less than immediately after the Middle East conflict began. According to Miwa Oni, head of equity research, West Africa at Stanbic IBTC Bank, he says the data supports likely Q2 2026 GDP growth of 3.94% year-on-year, slightly above Q1 2026 3.89%. Nigeria's 2026 growth is forecast at 4.1%. That's year on year for the whole of 2026, with risks from insecurity, renewed exchange rate pressure, extreme weather, higher fertilizer prices, and capital inflows in the second half of 2026. On capital inflows, Nigeria's planned return to the FTSE Russell Frontier Market Index has been paused over concerns that the new T+1 settlement rule could make investing harder. FTSE Russell says requiring payment 1 day after trade execution may force pre-funding and raise FX risks for investors. But operators argue the review should also reflect broader reforms in infrastructure, technology transparency, settlement efficiency, and FX access. FTSE Russell will announce its decision by the end of August. A further delay could affect admission to other major indexes and forecasted growth in portfolio inflows.
We've seen for 2025, for example, annual real GDP growth of about 3.87%, up from 3.38%. This is important because if you were to track nominal GDP, which is what people who advance credit would be focused on. That foreign portfolio investors, if you care, or banks, and so on and so forth. Nominal GDP is growing at almost 18% per annum. That tells you that Nigeria is doing something right on the macro side. This momentum has been sustained in 2026 so far. The results for quarter one 2026 shows the economy expanding by about 3.89% year on year compared to the same figures in quarter one 2025. So in quarter one 2025 it was 3.13%, and in quarter one 2026 we're growing at 3.89%. That again is a testimony of growth in the economy. You can also take another indication from the stock market. The Nigerian equities market ended in 2025 on an exceptionally strong note, posting one of the best annual gains in recent times, about 51.2%. The year-to-date performance in 2026 has been equally strong, about 55.7%, albeit at a recently subdued pace. The NGX All Share Index closed at 241,948.80 index points, and market capitalization stands at 155.21 trillion. All these indicators show, and I'll add one more before I tell you what the global rating agencies are saying to us. They show that Nigeria has been able to reduce its debt to revenue ratio from 95% in 2023 May today to 67% in 2025 December. The budgeted debt to revenue ratio for Nigeria is 50% at the end of 2026. So when we circle back at the end of the year, we'll see how well Nigeria has performed relative to that indicator. That indicator is very important because it is what global rating agencies also look at, together with the growth in nominal GDP and real GDP, in determining whether the economy is strong or resilient or whether it is investable. And so S&P Global recently upgraded Nigeria ratings to a B. A B is a strong rating. It's not exactly investable quite yet, but it shows a lot of improvement from junk status. And let me not name the countries that have recently gotten into junk status. This is not the time or place for that. But the important thing is to say that Nigeria appears to be going in the right direction. The previous upgrades were from B minus and Moody's B3 and Fitch B in 2025. B minus and Moody's B3 and Fitch B in 2025. So we see a clear positive growth in the economy. But when you go to the streets, what you keep hearing is people are not feeling it. But before I tell you why I think people are not feeling it, let's look at the tax numbers. Because like you know, Nigeria made a huge bet in 2025 on a new tax reform, which produced a new set of legislation called the Nigeria Tax Act. This act came into effect on the 1st of January 2026, and so we're in the implementation phase at the moment. You may have recalled that Taiwo Oyedele, the Minister for Finance, was quoted as saying last week that the initial revenue accretion to the federal government for 2026 has been a bit low. When you look at the company's income tax numbers, the variance is about 1.3 trillion negative. Performance rate is about 74.25%. If you look at the upstream company's income tax, the performance rate is about 66.91%, and the variance of negative 173 billion. Petroleum royalties, and so on and so forth. The numbers have tracked negatively against budget. But that's also because the government in that bill has given quite a lot away to taxpayers. So you can expect that there will be diminished revenue accretion to the government on the tax side. Trickle-down economics. That's how people are going to get direct impact of all these reforms. One of the aspects of trickle-down economy, of course, is a reduced tax burden. And most companies, most individuals are reporting a reduction in their tax rates. That tells you that people are beginning to feel the impact of these changes in their pockets. But a lot more work has to be done around structured employment, PMI indexes, and just getting people to the last mile.
Well, that's it on this special weekend episode of Global Business Insights as we close the first half of the year. This is Bodio Shosami. Thanks for watching. Bye-bye.